All right, welcome to The Explainer. Today we are going to tackle something huge, something that's all around us, but almost nobody really understands: how money is actually made.
So, let's just start with a really simple question, right? Where does money come from? I mean, it sounds simple, but the answer, well, it's way more complex than you think. We use this stuff every single day, but have you ever really truly stopped to think about its origin story? When you think about it, most of us probably picture some big government building with giant printing presses just churning out stacks of crisp new bills. That's the image we all have in our heads. But here's the thing. That's only a tiny, tiny piece of the puzzle. Because in a modern economy, like, say, the United States, only about 3% of all the money is actual physical cash and coins. 3%. The other 97%, well, that's the vast majority of our money. It's just digital. It only exists as numbers on a computer screen. That's it.
So that leads to a pretty massive question, doesn't it? If the government is only printing that tiny little 3% sliver of cash, who or what is creating the other 97%? The answer is probably not what you're thinking.
Okay, so let's get into it. The real money creators, the ones making that huge 97%, are institutions we deal with all the time. Private commercial banks. Yep, they are the ones who bring almost all of our money supply into existence. And it happens every single time a bank makes a loan. See, when you get a mortgage for a house, for example, the bank isn't just taking money from someone else's savings account and giving it to you. No way. They create brand new money, literally out of thin air, just by typing numbers into your account. And just like that, poof, new digital money enters the economy. So what does that really mean? It means that pretty much every dollar in our system is basically just an IOU. Money is literally created from debt. Think about this for a second. If everyone, every single person, every company, and every government paid off all their debts tomorrow, our money supply would just vanish. It would shrink to almost nothing. And hey, don't just take my word for it. This isn't some kind of conspiracy theory. This is a direct quote from a publication by the Federal Reserve itself. It's called Modern Money Mechanics. They state very clearly that banks create new money through loans because, as they say, if they only lent out existing deposits, the money supply would never grow. Now, there used to be a kind of break on this whole system. It was called fractional reserve banking. For a really long time, banks had to keep a certain percentage of their deposits, like, say, 10%, on hand in reserves. This put a limit on how much new money they could just create. But, and this is a really crucial point, that reserve requirement in the United States, as of March 2020, it was reduced to 0%. That's right. The main limit, the primary guardrail on how much new money commercial banks can create, is now effectively gone. Okay, so if the commercial banks are the ones creating all the money we use day to day, you might be asking, what about the central bank? What does the Federal Reserve do? Well, they're kind of the ultimate backstop for the entire system. And you don't have to guess what their power is. The Fed chairman, Jerome Powell, said it pretty plainly himself. As a central bank, they have the unique, almost unbelievable ability to create money digitally with no real limit. And they use this power in a process with a very fancy name: quantitative easing, or QE. But what it really boils down to is this: the central bank just creates new digital money to buy stuff, like government bonds, from the commercial banks. The goal is to flood the financial system with liquidity, especially when things get shaky. And the sheer scale of this is, well, it's just staggering. Just look at the numbers. Before the 2008 financial crisis, the Fed's balance sheet was under $1 trillion. Fast forward to 2022, after round of QE, and it had ballooned to almost $9 trillion. That's an explosion of new money. But here's the kicker: where does all that new money go? Mostly it flows directly into financial markets, not Main Street. And this creates this bizarre disconnect, a tale of two economies. I mean, look at April 2020. The stock market had its best month in decades, while at the exact same time, 30 million people lost their jobs. The new money just wasn't making it to the real economy where people live and work.
Okay, so let's bring this all back down to earth. How does this whole system of creating money out of debt actually affect you and me in our daily lives? Because believe me, the consequences are very, very real.
Well, the biggest one, the one we all feel, is inflation. It's that slow, silent killer of our savings. As the money supply just keeps expanding, every single dollar you have buys a little bit less. To put it in perspective, a dollar today has lost something like 97% of its purchasing power since the Fed was created back in 1913. It's pretty shocking.
But this whole thing gets even weirder. It brings us to a huge paradox at the very heart of the system. Okay, so remember, the banks create the money for the loan itself. That's called the principal. But every loan has interest, right? You have to pay back more than you borrowed. So here's the multi-trillion-dollar question. Where does the money to pay the interest come from?
The answer is kinda mind-blowing. It's never created. That's right, the money needed to pay the interest on all the debt in the system, it just isn't created when the loan is made. So what does that mean? It means there is always more debt owed back to the banks than there is money in existence to pay it back. It creates a permanent shortfall. It's like a giant game of musical chairs. There's just not enough chairs, not enough money for everyone to land safely. Mathematically, someone has to default. Bankruptcy is literally built into the system's design.
And this whole process also does something else. It systematically makes the rich richer. There's a name for it, the Cantillon effect. Basically, whoever gets the new money first, the big banks, the huge corporations, people who own lots of assets, they get to spend it while prices are still low. But by the time that money trickles down to the rest of us, prices for everything have already gone up, so our purchasing power goes down. It's a system that just naturally widens the wealth gap.
So, when you step back and look at the big picture, you see the central truth of the whole thing. Our entire financial system is built on a foundation of debt that has to keep growing forever. And this isn't some accident or a flaw in the system. It's the system itself. It's a feature, not a bug. And that's exactly why, when you look at a chart of the money supply next to a chart of the national debt, they look almost identical. They move in perfect lockstep, climbing up and up together. They have to, because in our system, money is debt. To get more of one, you need more of the other. They're two sides of the very same coin.
And all of this leaves us with one last really big, provocative question. This system, it's like a shark. It has to constantly move forward, it has to constantly grow just to stay alive. It requires perpetual expansion to function. So the unavoidable question we're all left with is, what happens when it can't grow anymore?